Sempra Energy just posted a massive bottom line beat for Q2. I mean, they totally crushed consensus, but they missed on revenue, and the stock barely moved. They reported an adjusted EPS of $1.16, which blew past the $1.01 to $1.03 estimates.
Right, but then revenue came in light at $3 billion flat, completely missing the $3.18 billion Wall Street was looking for. And they just maintained their forward guidance.
Yeah, so because of that, the stock opened at $84.06 and actually drifted down a bit post-earnings to around $83.88.
It's basically just hovering right below its moving averages.
Exactly. So today we're doing a deep dive into Sempra, ticker SRE, to figure out how on earth the company grows profits by roughly 30%, but sees its stock totally ignore it.
It's a wild disconnect between operational execution and market perception. I mean, the algorithmic models and human analysts are just seeing a ghost in the machine here.
And to hunt down that ghost for you, we have the primary sources spread out right here on the desk. We are looking at Sempra's earnings call transcripts, their SEC 8K filings detailing the financials, the real-time market reaction alerts from MarketBeat and Investing.com, and a very divided stack of recent analyst notes.
Right. We really should start with the gap numbers in that 8K filing, because the gap between estimates and reality is just striking.
Yeah, and for anyone listening who, might not spend their weekends reading accounting footnotes, GAAP stands for generally accepted accounting principles. It's basically the raw net income before they strip out the one-time events.
Exactly. And on a GAAP basis, Sempra's earnings were $796 million, or 1.21 cents per share.
Wow.
Yeah, compared to $461 million a year ago, that is a 30% leap in pure profit.
Which makes the flat revenue so incredibly confusing. I mean, revenue is down 0.1% year over year. Let me see if I have the mechanical reality of this right. Is this like a restaurant selling the exact same number of burgers as last year, but somehow finding a way to make them way cheaper to boost profits?
Well, not exactly. It isn't just about ruthless corporate cost-cutting to juice the numbers. It's actually about asset classification.
Oh, really?
Yeah. If you read through the management commentary on the earnings call, they specifically noted that part of this top-line drag is because they classified certain infrastructure assets as, quote-unquote, held for sale.
Okay, so they took revenue-generating assets and literally just moved them to a different column on the spreadsheet.
Correct. When you park an asset in the held for sale column, its contribution to your immediate top-line shifts. It just muddies the revenue picture.
And institutional investors hate muddy waters.
Exactly. When a company misses revenue targets by nearly $200 million, even with a massive profit beat, the market questions the long-term sustainability. You can only reclassify assets for so long before you fundamentally just need to sell more power.
Right, which brings us to the obvious question. If the overall revenue is completely flat, where did that massive $796 million in profit actually come from?
You have to look at their segment breakdown. The engine pulling this entire corporate train right now is located in Texas.
We're talking about Oncor, right? Their Texas transmission and distribution utility.
Yeah, the financial leap there is staggering. Oncor reported a net income of $428 million for this quarter.
Compared to just $259 million the previous year, that is an enormous jump for a regulated utility in a single 12-month period.
It really is.
But my instinct here, when I hear about massive growth in Texas, is to just chalk it up to pure demographics. Like, everyone is moving to Texas, they're building data centers everywhere, so they are selling more electricity.
Sure.
But reading through these analyst notes, it doesn't seem like just a simple demographic story. Did the actual rules of the game change for Sempra down there?
The demographic shift is definitely the foundation, but the regulatory framework is the actual catalyst driving this profit.
Okay.
Management specifically highlighted a process underway in Austin right now. State regulators are actively creating what Sempra calls a more durable framework for capital deployment.
I want to break down what a durable framework actually means for you listening, because it sounds like boring corporate jargon, but it's actually the holy grail for a utility company. We are talking about the regulatory compact here.
Yes, exactly. The regulatory compact.
Yeah.
In a free market, a company builds a product and hopes people buy it. But utilities operate under a compact with the state. The state grants them a monopoly, and in exchange, the utility spends billions to build the grid.
Right.
But the crucial part is that the regulators guarantee the utility a specific legally protected return on that money.
So if Sempra spends $1 billion building new power lines in Texas, the state guarantees they will make a certain profit percentage on it, and they let Sempra raise consumer bills to collect it.
That is the mechanism of a base rate review. And what Sempra highlighted on this call is the recent UTM legislation in Texas, the Utility Transmission Mechanism.
Got it.
Basically, Texas is actively sweetening the regulatory compact. They are making the process of recovering costs faster and more profitable because they are desperate to ensure their grid can handle all those people and data centers.
They're essentially telling Sempra, pour your capital into our state and we will make sure you get paid back handsomely.
Exactly.
And you can see Sempra reacting to that in real time, especially when you look at what they are doing out west. I saw a detail in the 8K about their Southern California gas subsidiary, SoCalGas. They just approved retiring all outstanding preferred shares.
Right, which provides a perfect contrast to the Texas expansion. Retiring preferred shares is pure capital optimization.
Let's unpack that for a second. Preferred shares are like a hybrid between a stock and a bond, right? They pay a very high fixed dividend that has to be paid out before regular shareholders see a dime.
And because those payments are mandatory, they are a heavy drag on cash flow. By using cash to buy back and retire those shares in California, Sempra is eliminating those expensive obligations.
Streamlining the balance sheet.
Right, so you have this fascinating dual strategy, aggressive, subsidized growth in Texas and defensive capital optimization in California.
Which on paper sounds like an absolute dream for an investor. But that leads us directly into a massive contradiction in our sources. We need to follow the money here because the trading activity around SRE stock tells two totally different stories.
Yeah, let's look at the 13F filings.
And for context, 13F filings are the mandatory quarterly scorecards that big institutional managers have to submit to the SEC. It forces the whales on Wall Street to publicly show what they are holding.
And the whales are gobbling up Sempra. We have an astonishing move by Senegon Asset Management. In Q2 alone, they increased their stake by 11,113.9%.
Oh, wait, over 1,000%.
Yeah, they bought over 403,000 shares. And they are just one piece of it. Vanguard, State Street, Morgan Stanley, JP Morgan, they all boosted their stakes. Institutional investors now own an overwhelming 89.65% of Sempra.
Okay, so the quote-unquote smart money is buying everything in sight. But here is the glaring contradiction. If institutions are buying, why are Sempra's own insiders aggressively selling?
It is definitely a stark contrast.
Over the last 90 days, Executive Vice President Caroline Ann Wynn sold 8,000 shares, cashing out over $724,000. Director Pablo Ferrero sold 2,600 shares. Insiders currently own a mere 0.31% of their own company.
The optics are jarring, I agree. But we have to separate the motivations of a multi-trillion-dollar asset manager from an individual executive. When Vanguard buys a regulated utility, they aren't looking for explosive tech stock growth.
Right.
They're looking for capital preservation and yield. They're buying the dividend.
Sempra pays a quarterly dividend of roughly 65 cents per share, right? So that's a yield of about 3.1%.
Exactly. In a volatile market, parking billions in a state-regulated monopoly that pays a reliable cash yield acts as an anchor. The stock is essentially functioning as a bond proxy for them.
But let's look at the math required to maintain that bond proxy status, because this is where it gets messy. According to investing.com, Sempra's dividend payout ratio is hovering around 89%.
Which is remarkably high.
It's crazy. It means for every dollar of profit Sempra generates, 89 cents goes straight out the door to shareholders like Vanguard. Only 11 cents stays in the bank. So how on earth do they fund the multi-billion-dollar grid expansion they just promised Texas?
Well, they have to issue debt. When your earnings are that depleted by a high payout ratio, you have no choice but to tap the debt markets.
Oh.
And in a high-interest environment, taking on new debt while maintaining a 90% payout ratio creates a highly pressurized balance sheet.
Which brings us right back to the insider selling. Because if you are an executive vice president with a massive portion of your net worth in SRE stock, you see that pressure. You see the stock stuck in a channel currently in the mid-80s, and you see the debt piling up.
It frames the insider selling not as a panic, but as prudent personal financial management. If your company's equity is behaving like a fixed income bond weighed down by debt, you diversify. You sell some shares to capture liquidity.
Because the stock isn't going to double overnight.
Exactly.
So the stock is acting like a bond, the revenue is flat due to asset reclassifications, and they are relying heavily on debt to fund growth. That intricate web perfectly sets up the final piece of this puzzle management's future guidance.
The market always looks forward, and Sempra's guidance offered very little for algorithmic models to latch onto. They just maintain their 2026 adjusted EPS guidance of $4.80 to $5.30.
Their 2027 guidance of $5.10 to $5.07. Now, on the surface, just maintaining guidance sounds fine. They aren't lowering expectations.
Right.
I was thinking about it like a college student getting an A+ on a midterm, but then telling their parents, hey, don't get excited. I'm still only aiming for a B for the semester. It just completely spooks the room.
The midterm analogy works for the psychology, but the financial mechanics are rooted in the terminal growth rate. Prior to this huge Q2 earnings report, the analyst consensus midpoint for Sempra was already higher than the guidance management just reaffirmed.
Oh, so Wall Street had already baked a certain level of accelerated growth into their models based on the Texas narrative.
Yes. So by merely maintaining the old guidance, management basically told Wall Street their models were too aggressive. But more importantly, it's about the cost of capital.
How so?
One of the analyst notes we reviewed specifically pointed out that balance sheet debt expansion is neutralizing the bottom line beat.
Right, the interest expense.
Exactly. If you generate higher returns in Texas, but the interest expense on the debt required to build that infrastructure rises, the net benefit to your future bottom line is capped. The cost of capital acts as a ceiling. Management knows this, which is why they refuse to raise the outlook.
And this structural tension has completely fractured Wall Street's verdict on the stock. If you look at the analyst ratings across the major banks, it is a house divided. The consensus rating is a moderate buy with a target around $104.23.
But the spread between optimists and pessimists is massive.
It's huge. On the bullish side, Wells Fargo maintains an overweight rating with a target of $118. Morgan Stanley has a target of $108.
Yeah. They are heavily weighting the Encore data and that UTM legislation in Texas. They see a multi-year runway for guaranteed returns.
Right, but then you looked at the bear case. Bank of America recently downgraded Sempra to neutral and slashed their price target to $76. We are looking at a $42 difference between the biggest bull and the biggest bear.
For a regulated utility, that means the smartest analysts in the world fundamentally disagree on what kind of company Sempra actually is right now.
It really does.
And that divergence perfectly encapsulates our entire deep dive. Sempra is a highly complex financial beast. On one hand, it is a reliably profitable, dividend-paying utility riding a generational infrastructure wave in Texas. But on the other hand, it is chained down by the mechanics required to sustain it. You have flat revenues from asset shifting, expanding debt loads to fund growth, and management offering highly conservative guidance.
Which explains exactly why a company can post a 30% leap in pure profit, only to watch its stock open at $84 and just sit there.
It is a profound tug-of-war between the physical grid and corporate finance.
So, as you continue to watch the energy sector evolve, I want to leave you with a final thought to mull over. We constantly hear about the unstoppable macro trends AI, massive energy requirements for data centers, and millions relocating to states like Texas.
Right.
And regulators are actively incentivizing billions to build the infrastructure required to power it all. So are we looking at a future where the physical, seemingly boring power grid quietly becomes the ultimate growth sector of the next decade?
It's a great question.
And if the grid truly is the next great growth frontier, how long can companies like Sempra disguise that explosive potential behind the conservative guidance, the murky revenue reclassifications, and the heavy debt loads of a quote-unquote boring dividend utility? Make sure to follow the show for our daily earnings coverage so you don't miss our next deep dive.